Welcome to the Traders Expo Las Vegas. I am John Netto, author of The Global Macro Edge, and I'm joined today by Suri Duddella from SuriNotes.com. Suri, thanks for being here.
Thank you, John.
You are an automated trading specialist extraordinaire. You have a lot of experience in building algorithmic trading programs. The one thing that people, along with just understanding automated trading, is really deconstructing and unpacking the risk around automated trading.
Right.
Not just about a system, but just some of the operational risks. I'd like to talk today with you in this segment about the risks associated and how you manage those, both conceptually and operationally.
Right. I think the risk is, of course, it's across the systems, whether you're discretionary or automated is there. But in automation, some of the risks which are not in your control are the automation of the computer-based risks, or even the execution risks.
Right.
These are something which you think, according to your program, should be covered, should be there, but they're not there because it's not in your control. Because they either anything could happen to your servers or anything could happen to your orders, which you thought it should be allowed. So these needs to be actually rolled into your system, and then you must account them before you actually execute the trade. And then another biggest thing is the order management itself.
Right.
Because when you're executing it, there are many times an order should be there, but there's a massive amount of slippage, a massive amount of movement within the markets itself. That is not, you cannot be able to see it.
So some of these things are, you touch on some practical things,
yes.
but some of this is still kind of abstract for people. Risk, automation, liquidity. Let's maybe run through challenges you've dealt with when it comes to not only managing risk, but let's say talk about a stop out point, like when a system goes through a kind of model decay,
right.
but both the risk to the strategy of the system,
right.
as well as just the implementation of the system.
Right.
Help us at a practical level differentiate between those two.
Fantastic. Well, as you know, that the markets change from time to time. So the models are not, perennial, they would work forever.
They're not bulletproof.
They're not bulletproof, and they change based on the market conditions. It's as simple as when you have a bullish strategy and a momentum-based strategy.
Right.
Those strategies on a sideways markets completely derail it.
Will struggle.
They struggle, and then if you happen to have a time-based exits or some type of a stop based on the percentages and all, they will not do that.
Yeah.
Right. So, and also you cannot predict the sideways markets.
Right.
Only thing is you have to account them before you actually release the strategy into markets. So one of the biggest thing what we do is when we first start with the strategy, when we first enter into the markets, we try to enter into the market with a much wider stop.
Okay.
But once the profit levels are reached, let's say 20% or 30% of the profit, what we assume,
right.
then we start tightening them.
Okay.
So that way, that even if the strategy goes,
it's like a stop and reversal dynamic in there. It stacks it up and it follows it.
Stacks up, and then there's a trailing goes on.
Right.
To at least take some part of it.
Right.
Because if your model completely goes wrong, so those are the things which you need to implement it, and you need to be aware of it in the strategies.
So that's the strategic level. You talked about sort of preventing against strategy decay, strategy breakdown. At what level? Now, one of the things that I'm big on is predefined risk budgets.
Yes.
So this is done ex ante. You say, listen, if this strategy loses this amount of money, you decide in advance that then you're going to cut it back or scale it back.
Right. I think every strategy is actually tested to see what is the levels of it. It's catastrophic.
Right.
So in that case, what happens is there are some strategies which fail at like 7-8% of its loss.
Right.
And some strategies probably have a little bit of a drawdown basis. So then we'll say, what is the best way to actually protect it? Whether it's a capital risk, whether through the portfolio way, or whether are you protecting just this particular trade itself.
Right.
So some of them are, and also depending on your capital.
Right.
Because you don't want to lock up your large amount of capital on a single trade.
Right.
Because your assumption is this and it's not working. So then also the time-based risk. We also limit it to time-based.
Sure.
Say, how much, whether it's going to take a week or whether it's take 1 day to actually get these profits. So those are the ones which you
Fair enough. Talk a little bit about the final risk component here is the psychological side, because some people would argue that, listen, our strategies are a manifestation of our opinions, our ideas, our beliefs. and there still is an ego involved, even with an automated trading system.
Right.
Share with me the emotional side of automating a system, and how that pertains to managing risk as well.
Sure. I think one of my saying is if you are a poor discretionary trader,
Right.
you will be a poor automated trader.
Great line. Great line.
Because just because you built an automation system and it showed all these great things, it doesn't mean that it's automatically going to make you money.
Sure.
Because what happens is the emotions, what you're talking about, they also play in the automation, exactly same way.
And that's not talked enough about either.
Yes, if you haven't mastered your emotions in a discretionary trading or any type of a trading, you then automation, when it shows you a drawdown, let's say you think you will have a drawdown of 8%, let's say it comes to 12%.
Right.
Then automatically you just say that no, I can't, because that's what it's driven by emotion.
Right.
And then you get out.
Right.
Even though your strategy may be saying no, you need to hold on to
a 25% stop is the most appropriate, but at 12 you cut it.
You cut it because you are not mastered.
Right.
So these are the things which is a lot of automation traders need to realize it.
Right.
As I said, it's not an easy thing for even with an automation, right? So that's the reason maybe there are some. There's a lot of people say that I'm going to hire a coder or build a system.
Right.
But if you haven't tailored to your psyche, your type of a psychological build up, the automation is not an answer.
Fascinating stuff. Suri, we hit a lot of things in this interview. How do people get a hold of you?
Thank you, John. My name is Suri Duddella. My website is surinotes.com, and also my email is surinotes@gmail.com.
Thank you for joining us today, Suri.
Thank you, John. Fantastic. Thank you.
Perfect.